Hey everybody, hope you guys are doing awesome. I'm gonna
Hey,
wait
Troy.
just a few minutes here to let everybody come in from the waiting room. And I'm sure per usual, lots of people on realtor time. So anybody have any exciting stories from over the weekend while we wait? No?
Looked like you were out of the state on social media, at least.
Yep, I was. It was good. So every once in a while get away. It was nice, no kids, just overall pretty chill. So I was out there for a coaching conference. So it was good.
Nice.
You have Airbnbs, right, Joe, or at least one?
Yeah, I own one and I'm managing another and looking to add more to the portfolio.
Okay, cool.
Yeah.
How have those been going? Have you been staying pretty booked?
Yeah, well, I will say winter was a little slow,
Yep.
but I think things are really picking up. We got lucky and got someone to book our Airbnb in Italian Village for 28 days. So a lot less maintenance. You have some experience with Airbnb too, right?
I do, not a ton. We're just getting rolling in that. So
Okay.
what out of curiosity, and then I'll stop having this very specific conversation with almost nothing to do with what we're talking about. But what kind of discount do you give for a monthly rental?
We did 10%.
Okay.
Yeah, I think it can kind of vary. Depends on what you think is competitive, but
Yeah,
yeah,
no, that's not bad though. I mean, that's a pretty good, you probably made out really well though, because obviously the chances of booking every 28 straight days are almost zero if you're booking
exactly.
for anything like mine. So
Yep. Yeah, we can
yeah,
talk about it later too.
absolutely. All right, cool. Well, it looks like at least for the moment, we have everybody in from the waiting room. So I'll go ahead and get started. Obviously, when we're talking about the real estate market, there's a lot to talk about right now. And so I would love to have a pretty interactive class. If you guys want to chime in and let me know what your current markets are looking like, that would be awesome. So definitely feel free to either raise your hand, type in the chat, or just unmute is probably the best way. Sometimes I get rolling, and when I put the PowerPoint up too, it kind of shrinks everything else down. So, but I'll introduce myself real quick. My name is Troy Marsh. I am in Columbus, Ohio. I've been an agent since 2004. Been a team leader with KW. I'm also an investor and own a construction company. And so just for whatever reason, numbers are one of my things. I enjoy it. So I tend to be the resident displayer, I guess, of the information here in my office. And so Dana asked me to start doing this, and then feedback was pretty good. So we've started to do it on a monthly basis. So here we go. I'll roll with this. If you guys want the copy of the PowerPoint, I'm happy to email that to you. So just you can email me. I'll put my email in the chat here, and you guys can email me, and we'll get it sent right over to you after the session. And then I believe the recording goes up on our YouTube channel as well within a couple of days. So lots of different ways to get the information. So I'm going to go ahead and jump right in. If that's okay with everybody else. Does anybody have any questions up front or any specific topics they wanted to chat about? Or I'll just jump right in and we can do that at the end. All right, cool. So June 2022 update, market update. So lots to talk about. Really, actually, some of this information is just from Friday. So basically inventory and selling trends. I like to hit on the major ones right away at the beginning. Interest rates, which are certainly the story of the year so far, in my opinion. And a big reason for that is the inflation, which we'll talk about both of those. Affordability, which we've talked about last month, and then foreclosure data is something new that I threw in, not because there's necessarily a bunch to talk about, but just I think the conversation. I think most everybody on here are real estate agents. And if your life is anything like mine, everybody thinks that 2008 is going to happen again next week. And so just wanted to give you some data to throw back. And really, the purpose of this class for me is to share, the research that I'm already doing with you guys. And the goal is really, I follow Gary Keller a lot, and Gary Keller always says, as real estate agents, we should be our clients' local economist of choice. And having gone through the 2008 downturn, I felt like one of the things that really helped me during that time was understanding lending, and then also understanding the numbers, because to be honest with you, and I think we're back here for sure, I don't have this information in here, so I'll say it right at the outset. Consumer confidence in terms of whether now is the right time to buy a home is at a historic low. I'm not sure it's quite as low as it's been, because I actually don't think that they tracked it back in 2008. But it's certainly the lowest that it's ever been since they started. I think they said like 2013 or 15 is when NAR started doing that survey. And I think it's over 80% of people surveyed believe now is not a good time to buy a home. They do think now is a good time to sell a home, but they don't think now is a good time to buy a home. So I think as agents, if you're in one of the markets where we're seeing downturns or significant downturns in terms of sales, and inventory is rising quickly, your ability to have that conversation and make buyers feel comfortable about making a purchase in today's market is absolutely imperative. And it's going to be the difference between you taking market share during this time and losing it. So I'm going to go ahead and jump right into the data. So inventory and months of supply still remain at all-time lows. So even though the story and the headlines is that, inventories are rising, the reality is we didn't have much of a place to rise from, because most of us were at just ridiculous lows. And for the most part, those inventory levels have not even come close to the average from 2017 to 2019. So that's one thing to keep things into perspective in terms of where we're coming from. And then also, so let's jump right in then, new listings. So new listings were up 6.3% compared to May of 2021. So these numbers from realtor.com are looking at May compared to May in most cases. So you can see this green line here is 2021. The yellow line is 2022. And keeping in mind that May was the first time so far in this calendar year that we've seen more new listings than last year, you can see it kind of rode the same trajectory. And then in May, we shot up a lot. And so that is definitely something to look at. Now, we're still, as you can see, other than the pandemic year of 2020, we're still below where we were in 2017, 18, and 19. So again, putting things into perspective, the sky is not yet falling. Like, the trajectory is not one that we want to continue necessarily in a strong way, but we're still well below. So when people act like 2008 is just around the corner again, we need to pump the brakes on that conversation a little bit, because I think most of us sitting here in 2017 to 19 would have said that those markets were really strong. They were still very strong seller markets. And just because we've increased above or we've slowed down more than last year does not mean that we're entering the worst market of all time. Active listings, that did pop above the trend line for last year again, in May for the first time this year. But again, putting into perspective 17, 18, and 19, we have a long ways to go. We're still at nationally below 50% of where we were in 2017, 18, and 19. So when we talk about historical trend lines, really we're still well below where we need to be. Pending listing count was flat for the most part, which is not something that we typically see. As you can see, April to May, things do start to flatten out a little bit, but I would say we're probably a little bit flatter than what's normal. Obviously, May of last year was a very strong year for pending sales, and so we're down about 12.6%. But Also keeping in mind the last two slides that we've had less inventory than ever before. So, this is something the general public, in my opinion, doesn't understand, and neither do the people that are publishing these stats a lot of times. But pending sales are a lagging indicator. You first have to have new listings in order for them to actually go into contract. So because we've been below market in terms of active inventory over this whole year to date, it would only make sense that the number of pending sales would be below last year since we've been listing fewer homes. So again, I think it's trajectory that we definitely, it's showing that things are slowing some, but I think the sky is falling is a little bit of an overreaction. I do like to throw in some local numbers, and what I kind of wanted to do this more than anything. I know we have a lot of people from across the country on here, so this may not be relevant, but this is the Central Ohio local market. And I want to throw this in here because it shows the difference between a national market and a local market. And I think if you can take one thing away from this presentation in terms of being able to talk to your clients, it is that every market is local. Some markets are seeing much worse than what we just showed in terms of the average. Our market, and when we get to a slide further into the slide deck, you'll see that I think the Midwest in general is faring a little bit stronger than some of the, the cities that saw massive appreciation, over the last couple of years. So you can see new listings are about even with last year, May over May. Solds are down 4.3%. Again, that's due to the lower inventory year to date. And the pendings actually here in Central Ohio are up almost 5% compared to last year. So if we consider the fact that we've had almost the same number of new listings, but we have 5% more pendings year to date, it definitely means, things are good. I would say for those of you that are real estate agents, which I think are the majority of the people on this call, obviously the lower sold units means less commissions are being paid out. So if you're feeling like the market is crazy, but your bank account isn't necessarily reflecting it, certainly, solds being down 4.3% for us here locally. And then also at the same time, we're adding real estate agents. That's putting a further crunch on opportunities for each person. So here's everything kind of in more of a statistical, actually, you know what? I didn't update that last slide. So solds are down 3.6% and pendings are up 2.8%. Still same kind of conversation, but I didn't update that last slide. So sorry about that. But I also wanted to show this because I think this is very relevant. Even in a market where the solds are down, you're seeing days on market still better than they were last year. So that means still the new listings that are coming on the market are still selling, and they're selling faster than they did last year. So on average, 16%, even looking at May, the first 12 days of June compared to the first 12 days of May, the average days on market is down about 17% here locally in Central Ohio. So if we jump back to the national numbers, we see kind of the same story. So even though all those numbers kind of point towards a slowdown and everything else, we're still seeing the average days on market down 6 days compared to May of last year. So that is significant in my opinion, because it's still showing that there might be a little bit less buyer demand out there, but the buyer demand still outpaces the available inventory. And this is another thing that I think speaks to that as well. If we were seeing a massive amount of homes coming on the market with no buyers, we wouldn't be seeing year over year appreciation for median list price up 17.6%. So still a 3.4% increase just over April. Now, again, these are the list prices. So, does this translate into sales prices? We'll see. It may or may not as we move closer. Again, this is hopping back to Central Ohio just for a quick minute. Quarter over quarter, March to May last year, up 14% locally. So a little bit less than the national average. And I think you'll see that a lot of the Midwestern cities, they haven't seen the 30 and 40% appreciation. So you may see them have a slower glide in terms of slowing down than maybe some of these other places where affordability is just absolutely out of control. Price reductions definitely jumped up from April to May. Again, well above last year at the same time, but still also well below the 17 to 19 trend. So, still moving in a direction of more of a balanced market, but certainly not anywhere near where I would be freaking out at this point. Interest rates. So here's obviously the biggest reason for all of this, and that is that interest rates over the last 15 years have been historically pretty low. And then here over the last few days and weeks, certainly since the beginning of the year, we've seen them go up a lot. So you can see even last Friday, which we'll jump into in a second, last Friday rates jumped 0.3% on average. And mortgagenewsdaily.com has the average quoted lender interest rate for a 30-year fixed at 5.85%. I think locally here we're a little bit better than that, but certainly much higher than we were just a few months ago. So this is looking at what rates were at the beginning of the year. Again, according to mortgagenewsdaily.com, but you can see the impact on someone's payment. So you're looking at, for a $300,000 loan, you're looking at $464 a month. For a $600,000 loan, you're all the way up to $928 a month more for the same property. And that's at the same price, but obviously also at the same time, prices have gone up as well. So you're definitely seeing some pretty big sticker shock if people haven't talked to their lender in a couple months. Was somebody trying to say something, or did they just accidentally unmute? Everybody good? You can drop stuff in the chat too if you have questions. All right, we are now meeting a historical, I guess, benchmark that we didn't want to. We're now the second largest rate increase ever in history year to date, except for 1979, which I think, if I've heard the story one time, I've heard it 10,000 times of, I remember in 1981 when I bought my first house and interest rates were 18%. And so this was, 1979 was kind of the major introduction into those higher rates. You can see it kind of started a little bit in 1978, but certainly in 1979 that kicked it off, and then it continued into 80 and 81. And the big, I guess, concern that everybody has when we talk about interest rates is that, the driver for those high interest rates back then was inflation. And now is also the time when we've had more inflation than we ever had. So this is just something to continue to watch. If the economy continues to keep chugging along the way it has so far, in spite of inflation, then I think we'll continue to see interest rates rise. The Fed is raising interest rates in order to try to calm that down, but we're hitting some pretty interesting benchmarks here. There's a lot of variables at play in terms of what type of economy we have and how that's going to impact us, but so far it's been eerily similar, which is a little bit concerning. So this is a little bit about inflation, just again, trying to educate you guys a little bit on all these numbers and phrases that are getting thrown around. So there's really two types of inflation, and the one makes no sense to me other than, I guess, what I'm about to tell you. So maybe it does from that perspective. So the number that came out on Friday, which caused the interest rates to jump up so much, is what we call the Consumer Price Index, or CPI. And that's basically everything that we use, including food and energy. Now, the funny thing is they also measure what they call core CPI, which in my opinion exclude the two core things, and that would be food and energy. I don't know about you guys, but I don't think many humans live without food and energy. So I would think that those two things would be called core and the other something else, but here we are. So that number that includes food and energy jumped last month unexpectedly, which if anybody's been to the gas pump over the last month, I'm not sure why it was unexpected, but it was, according to the really smart economists that predict this stuff. And so that was the reason why interest rates flew up, because frankly, they were expecting it to go down, which it had for the last couple of months. You can see this kind of little tick down here. And so they were hoping that that was going to be a trend. The positive news that came out though on Friday, if you dig deeper into it, is that this core CPI, which excludes food and energy, did continue going down. So that means the goods and services that we all are paying for outside of food and energy, those prices are starting to balance out a little bit. I don't know if you've seen the news, but Target announced last week that they were going to be planning on cutting some prices to get rid of extra inventory. Sorry to all of you out there who might have a spouse that likes to spend at Target like mine does. But there's going to be a lot of deals at Target over the next couple of months, which is lower prices, which will help again lower inflation. So that's kind of all about inflation there. One other thing I wanted to point out really quickly, because this is digging deep into numbers and you guys might all be glossing over already anyways, but yeah, Friday was a really good way of showing this. So this is a chart that shows what happened to stocks and then also what happened to the 10-year treasury, which is the main driver of 30-year interest rates. They announced that higher inflation number and immediately stocks plummeted, and that causes basically money to move from stocks into bonds. And so that forces interest rates up. So typically, and this is very general and not always true, but you can kind of, if you see bad news, it's usually going to mean that interest rates are going to go up, at least in the short term, and stocks are going to go lower. And good news is kind of the opposite. So if we begin to see inflation kind of balance out and lower, then we'll probably see interest rates come back down. If we see inflation continue to go higher, which would be considered bad news, we'll probably see interest rates continue to go back up. Mortgage applications. Sorry, guys, that was one that got left in here from last month. The affordability numbers are based off are a month behind. And this is from Black Knight. You can see affordability continues to be impacted by both rising prices and rising rates. So we're almost at the highest payment to income ratio that we've ever been at. We're at 33.7. And the highest was in 2006 at 34.1. So affordability is definitely a thing. This is what I wanted to talk to you about, though. I thought this was super interesting when we're talking about local versus national. I'm not sure there's a better way to show this. So you can see here the highest and lowest markets for affordability. So you can see LA is the least affordable market. So the average person would have to use 69.6% of their income to pay for the average mortgage payment in Los Angeles right now. So you can see LA, San Jose, San Diego, San Francisco, Vegas, Seattle, Riverside, California, Sacramento, Phoenix, and Miami. But then you come down here to the lowest of the top 50 metro areas, and you see Milwaukee, Louisville, Pittsburgh, Chicago, Rochester, New York, Cleveland, Cincinnati, Kansas City, Detroit, and St. Louis are some of the most affordable places. And so I think all of that is something that, again, you guys definitely make sure that you're doing your research for the information in your local market. And mortgage delinquencies. So why is this not 2008? Obviously, none of us can predict the future, but certainly the current data usually tells us what's coming, and the delinquency rate is actually down. So it's a new low of 2.8% since they started tracking it, and foreclosure starts are actually down, which is good. Active foreclosures actually edged a little bit higher, but the number of new foreclosures is going down. So I think until we start seeing those go up, we need to be careful about thinking that 2008 is happening again. And then we also see here from a chart form, the delinquency rate compared to the historic average is still well below. And this little thing right here is looking at the 2000 to 2005 average and seeing that basically we're at a record low right now in terms of delinquencies. So what do I think could increase delinquencies? I think a major recession and slowdown in the economy, which would likely lead to a lack of employment or increased unemployment, could cause somebody to fall into foreclosure, which foreclosure, and losing a job and all of those things can be a really emotional experience. And I know for those of you that might have been in the market back in 2008 to 12, when there were a lot of short sales, sometimes people had the equity and just were so distraught and kind of depressed about their situation that they just did nothing, even though they could have sold. But the reasons I think that a high number of foreclosures are unlikely right now is a couple, and I guess one I left off of here. Most homeowners have massive amounts of equity that allow them to sell without a foreclosure if they lose their job. And I think to piggyback on that, most homeowners right now have 30-year fixed mortgages, so their payments are unlikely to change. And the other thing is rental rates in most markets have increased as much or more than home prices. And so the reality is if they let their house foreclose and they go rent a property, they're likely going to be paying more than they would have been otherwise. So that's definitely something to think about. So conclusion, affordability concerns due to rising rates seem to finally be impacting sales. The question is, how high will rates go and will employment become an issue? The rise or lack thereof of wages continues to be an issue when it comes to inflation around goods. And I think if we continue to see inflation without rising wages, then we will likely dip into a recession because people will just stop buying. When we talk about interest rates in general, actually a recession would likely be good for interest rates because it would basically, again, force people back into or basically pull people out of the market in totality, and they would have to reduce rates in order to kind of jumpstart the economy again. So it's a weird dynamic, and you can see, like, just from looking at these numbers and then talking about how actually a recession would help interest rates, why the Fed is in such a predicament, because it's really a balancing act for them, and no one knows exactly what triggers are gonna let things, cause things to level off. But what I'm looking for is lowering lending standards, which we absolutely have not seen up to this point. Higher days on market, which again, we have not seen. We have seen more price reductions. Is that due to sellers overpricing properties, or is that due to an overall slowdown? That's really the big question. Affordability getting even more out of control, so rising prices and interest rates, which we have seen. And so we're kind of ticking off a couple of these boxes right now. And so we're definitely looking for changes. So and then here's the sources that I used. Again, I'm happy to send all this stuff to you, or these specific slides over to you to review. Does anybody have any questions at all on any of this stuff, or any comments that you guys would like to discuss? No? Either I did a great job or half of you guys are sleeping, and it could be a combination of both. So, well, you guys can feel free to email me if there's anything else that I can do, or any other specific questions I can answer. But again, I would just encourage you guys to become your local economist of choice. It doesn't have to be nearly this detailed. I'm going to keep doing these, so I'll bring you kind of the national news to be able to get out to your clients, but just make sure you understand what's going on with the showings, what's going on with your local days on market and all of that stuff, because I think it's really important for both working with buyers, but then also setting expectations for sellers. It's pretty embarrassing when you tell somebody that they're going to get 30 showings and 20 offers, and then you put it on the market and there's 3. So understanding what's happening is definitely something that's really important. So thank you guys for jumping on, and feel free to email me if there's anything else that I can do to help. Have a good one.
Thanks, Troy.
Yep.